Good morning everyone, welcome to Ainsley News. Middle of the week, Wednesday the 18th of August. A 36% crash ahead for the S&P 500. From our perspective, it's pretty much on the cards, considering how overinflated this market looks. There is a sense of growing uncertainty in the US equity markets despite, or maybe because of their hitting all-time highs this week amid growing concerns around the Fed's next move and growth concerns. Last night saw a correction of nearly 1%, ostensibly on the back of poor retail sales data, joining a host of disappointing economic data, signalling weakness ahead. One of macro investors Raoul Paul's favourite prints is the Bloomberg Macro Surprise Index, and it's currently plunging deeper into negative territory, i.e. the experts keep expecting better economic data than the reality is printing. Here's that US Macro Surprise Index here. Another measure of the market potentially getting it wrong is the ratio between the VIX and the VVIX. Most readers will be familiar with the VIX being the CBOE's volatility index, measuring expected volatility in the S&P 500 and generally seen as an index of fear. A less understood index is the VVIX, which is somewhat ironically, it's an index that measures the volatility of the volatility index of the VIX. Whilst the current everything is awesome market has an understandably low VIX, the VVIX, arguably more traded by smart money, has been creeping higher. That stronger numerator and declining denominator resulted in a ratio at a historically significant high of 7.5 this week. Per the chart I'm going to show you here, you'll note that each time it has reached such highs, a large correction has soon followed. Here's that VVIX versus VIX here. Last night saw the VIX surge to almost 19.5 and hence the ratio dropped to around 6.7 at the time of news today with us. This volatility comes after the S&P 500 hitting a milestone, unvolatile 6 months in a row of positive price growth, an extraordinary rare occurrence and one normally followed by a sizable correction. The VVIX is likely telling us that a market this extended at a time when its major driver, Fed monetary stimulus, is looking like possibly shocking the market through tapering, is prone to a big shock itself. And when we say extended, check out the following from Real Investment Advisor's Lance Roberts. This from him. This is also where investors should be paying attention to the risk they are taking on. As shown, there are a few points in history where the index, monthly, is this extended, deviated and bullish. There have only been 6 previous points in history where markets were simultaneously this extended, bullish and overbought. Each of these periods marked more historical performance peaks. 1921, 1937, 1946, 1957, 1987 and 1999. Importantly, the 72-month moving average has acted as long-term running support for the market going back to 1925. Violations of that moving average are rare and only occur during mean reverting bear markets. Currently, a correction to the 72-month moving average would require a 36.5 decline. Wow, 36.5% decline is quite massive. There's that chart here too for perspective. But the market is more than Fed stimulus, you say. No doubt there have been strong rebounds out of the depths of the initial COVID recession. But it's just that, a rebound. There's simply no getting away from the correction between the share market and money stimulus charted here. Is that Fed balance sheet versus the S&P 500 for perspective as well. And so with the annual meeting of central bankers as Jackson Hole just next week, where such big announcements are often made, and after the headlines of the big NFP payrolls, CPI and PPI prints, the Fed may feel forced to indeed taper their QE program and try to pull back that exponential orange line above. That same chart tells you what happened each time they tried that before, and at times where the market was less extended than it currently is. Gold loves a high, and climbing VIX, as you can clearly see in the chart we're going to show you next. The all-in crowd don't believe the Fed will be brave enough to taper, and hence a volatile shock would likely ensue. What's missing in the chart next for Aussie investors is that such shocks often see a USD surge, and hence, as happened last night with gold almost steady in US dollars but considerably stronger in Aussie dollars, the Aussie dollar drops and adds further gains to the price in local terms. Of course, if the Fed doesn't taper, the growing concern of currency debasement and bubble fears around the Fed being behind the curve could just as likely see more money flow into gold as a hedge. The Fed's dilemma is gold's each way bet. It's the last chart here. For more perspective there. We've got the volatility index, or the VIX on the right, and the gold fixing price in US dollars. Well, thanks for joining us for news again, everybody. Remember, jump over to ainslieBullion.com.au for all things physical, gold, silver, and platinum in our Brisbane and Melbourne office. Jump over to ainsliewealth.com.au if you're interested in crypto. Jump on that Bitcoin wagon. And also goldsilverstandard.com. That's our own cryptocurrency, built and backed by real gold and silver. Spread the word, and we'll catch you tomorrow for more news.